Morning, everybody. We're just going to give it a few moments here to let the webinar populate. Hope everyone's doing well on this Masters Thursday. I normally have the virtual background, but I thought the start of the Masters, I guess won't go with the virtual background today. Do my best impression of Jim Nance. Welcome, friends. All right. Well, looks like, room's pretty populated, so we're going to go ahead and get started. Good morning, everybody. Welcome to the 2025 Liberty Insurance Agency Insurance Industry and Trends webinar. My name is Kevin Heher. I'm the president of Liberty Insurance Agency. I've got over 20 years of experience in the business. It's amazing how much time flies when you're having fun. Go ahead, Elena, go to the next slide if you could, please. That's myself. Like I said, graduate from Villanova University. Next slide, introduce Jeff Conway. Jeff is the co-founder of Conway E&S, established in 1996. Over 30 years of experience in the wholesale property and casualty industry. Began his career as an underwriter, broker for a national wholesaler, graduate from Drake University with a degree in business finance. And then finally, Meredith Hunter. Meredith is the Senior Vice President of Proprietary Products at Amwins. Over a decade of experience with Blue Cross Blue Shield, focused on program and product development, holds a BSBA in finance, banking, and risk management and insurance from Appalachian State University. So welcome, everybody. Welcome, Meredith and Jeff. So today we're going to ask some questions of our panelists. If you do think of questions along the way, please feel free to enter those into the chat. And if we have some time at the end, we'll absolutely talk to those about we'll ask those of our panelists. Meredith, we're going to be talking a little bit about trends on employee benefits. Jeff, we're going to be talking a little bit more about property and casualty, maybe some overlap in between. But with that, Meredith, we all pay premiums. Those premiums are typically going up, not going down. Want to talk a little bit of peeling back the veil of why those are going up. Prescription drugs have been a big driver of health insurance costs, with specialty drugs, GLP-1s on the rise. What's on the horizon for group health plans to consider to mitigate the financial impact of higher cost prescription drugs, medications, and what appears to be a potential overutilization of GLP-1s?
Sure. Yeah, great question. I would say that the three leading causes of what we're anticipating to be a hardening market are: one, utilization. Since COVID, utilization in the healthcare space has declined tremendously. And in fact, we are still 7% below in terms of utilization where we were pre-COVID. And so, unfortunately, it's going to take a lot to catch up to where we were pre-COVID. We lost a lot of lives during COVID. But we do expect in the year 2025 to get back to a normal utilization pattern. And obviously, as we see more and more procedures taking place and claims cost going up, with that, it is going to be passed down to the payer, right? And we're going to see premium increases related to that. A second reason we expect a hardening market is payer-provider contracts. Right now, the average is about a 5-year-old contract, right? And so we're going to see a lot of contracts renewed in the year 2025. And those contracts are going to take into account, among other things, new technology. It's also going to take into account
inflation. I mean, the bag of Dorito now costs $6 back in 2025. I thought I was 2 for $4. I was shocked when I went to Target the other day. It was $6 for a bag of Doritos. So, right, like you said, when a 5-year contract is expiring, of course, whether it's labor input and then technology.
Yes.
Yeah, you're gonna have that. But yeah, sorry, get interrupted, but go ahead.
No, I'm glad you stepped in. Inflation. So where we all felt the pressures of inflation in the year 2024, those really won't catch up in the medical world until 2025 when we start to see these contracts renew. So believe it or not, we've been underpaying providers for the last 12 to 24 months with regards to medical expenses. And then payer competition. So competition is vast in the payer space. We have many stop loss carriers. There are MGUs that exist in the market. You've got your BUCAs, so Blue Cross, United, Cigna, Aetna, and they're all competing to win business. But what we've seen in the last year is a lot of stop loss carriers, MGUs, et cetera, are starting to merge together, and competition is shrinking, which allows carriers to sort of request that rate increase, right? There's less competition in the market. And so
Sure.
those three things combined are certainly going to create significant pressure on premiums. In addition to that, we talked about new technology. So think AI as a great example of new technology in the market that's revealing medical conditions and allowing us to be better prepared for the risk at hand. But also you talked about pharmacy expense. It's interesting. We continue to see more and more really cool drugs coming out of the FDA. And while they are sometimes curative, certainly are helping with maintenance of care for chronic conditions, they come at a cost. And so many of these new drugs that we're seeing are under the specialty tier of drugs. A lot of them are infusions. And so there is a high markup when it comes to infusions, and all of that is ultimately going to be passed down to your premium dollars.
Right. Yeah. I mean, I typically think and tell people that if you see it advertised on television, typically think there's a 5-figure monthly cost for that drug.
Right.
And then just real quick on GLPs, obviously, I'll use the term exploded over the last year. You know, as those contracts are being renegotiated 1171, a lot of carriers are basically trying to say, unless, you know, you've got that documented medical condition treating for diabetes, not covering that for weight loss. Any additional comments on that other than that's the trend that we're seeing, and to expect people that may have been having that GLP-1 covered under the medical plan at a renewal, you either have to buy up to include that coverage or it's going to be out of pocket?
Yeah, great question. So GLP-1s are going to be really interesting to watch over the next 3 to 5 years. I think we're obviously seeing high utilization on this drug. We're seeing a lot of inappropriate usage on this drug. And so I think medical policy is really going to take over in this space and creating really strict boundaries for when GLP-1s are able to be prescribed and used on the health plan. I think the other really critical thing to watch is transformation in how we are actually administering GLP-1s in the future. So many manufacturers are developing oral alternatives. So you would no longer need an actual injection. And they're also working on some of the side effects associated with GLP-1s. And as we see a reduction in negative side effects, we see an oral alternative that's only going to further increase utilization.
Sure.
Is certainly what's anticipated. So, you know, while it's certainly not a severity issue, it is a frequency issue. And so the best way to manage that is typically through medical policy. And we'll continue to see plans really strengthen the verbiage on what is allowed in terms of GLP-1 utilization.
That's great. Thanks for that insight, Meredith.
Sure.
Jeff, property and casualty side. Certainly, unfortunately, in the headlines with the wildfires in LA, Pacific Palisades. But when you look at the government from the data from NOAA, there were 27 $1 billion weather events in 2024. Tornadoes, wildfires, convective storms, severe convective storms, hail, obviously hurricanes as well. Helene, we know the names and the devastation that they did. The 5-year average for events is 20.5. So over the last 5 years, there's been on average 20 and a half storms. This last year was 27. and the forecasters continue to see that trend increasing because of climate change, people, demographics, people moving. So we've seen a reaction in the marketplace. Property rates are going up, whether that's on your homeowner side or if you've got a schedule of commercial property, manufacturing, lesser's risk only buildings. Can you talk a little bit about the reinsurance marketplace, how they're responding to that, how capacity impacts those renewals? Because I know that was a big conversation, certainly last year for the 1/1 for 2024 1/1, and it's continuing to be important moving forward.
Yeah, no problem. Thanks for having me. I think a lot of folks that I come across don't understand the reinsurance marketplace that sits behind the everyday primary carrier like the Travelers and Chubb and Liberty Mutual, et cetera. But there are some of the largest insurance companies in the world, and they've become, as Meredith was mentioning, the market shrinking. That has happened in the reinsurance marketplace as well. But you may not have heard of companies like Swiss Re, that's Switzerland. They do 40 billion a year in gross written premium. Munich Re, out of Germany, 32. These are the largest in the world. So Berkshire Hathaway, you've heard of. That's Warren Buffett's company. They 27 billion. Hanover Re out of Germany is 27 billion. Lloyd's of London, which you've heard of, is 22 billion. And Score Re out of France is about 23 or 20 billion, sorry. And so, and the reinsurance marketplace, the reason it exists is because risk that's above what the primary carriers can or are willing to insure provide, at the lower probabilities of loss, they provide capital and capacity to be able to put up the limits and that are necessary to cover larger
significant weather events. Exactly. Yeah.
Exactly. So you see, but here's a perspective though for you. Those companies are worldwide. They're vastly diversified. And an example would be Hanover Re out of Germany. I was reading about their take on both the market as well as the LA wildfire, and they predict that loss is going to be 30 to 40 billion, the LA wildfire loss. So it's a massive one, and their portion of that they predict to be 500 to 700 million in loss, which for the fourth largest reinsurer in the world, that's only 2% of their writings, as far as not writings, but 2% of their writings of 27 billion. So it has an effect in the marketplace, but they don't believe that, for example, the LA wildfires is going to have as much of an effect as people may think, partly because the marketplace in the reinsurance world, which is heavily data driven, which is heavily actuarially based, predictive modeling driven, believes that the past 2 years, 23 and 24, corrected the market in a way, and I'm talking property casualty, that is plateaued.
Yep.
And so what you saw was in January 1st of 25 was pretty much a flat renewal season, but some of the areas that are the most difficult are what we're bringing up today, or what you'd expect, the severity driven risks, the risks that have had losses. So cat property is still hard. Habitational business has not been good because there's been a lot of losses throughout the country, in the U.S.
Every habitational property has 50 kitchens instead of one, right? So they don't like the probability of fire. I think it's interesting too, Jeff, where the impact of interest rates, like we saw the property rates really going up these last 2 years. When the risk-free rate is zero, people are looking for yield. They're looking for return. And historically, the reinsurance or the retro marketplace was a place they could get return. You combine inflation, increase frequency of intense storms, plus the risk-free rate going to 5 or higher. People said, hey, in order for me to take the risk, I want to get more return. And that drove, like you said, the rates, the increasing, or people deploying capital in other areas. But now that the rates have gone up, there's been an increase in capacity. So we're hoping to see that stabilization. You talked about the wildfires, Jeff. Can you talk to people a little bit about the insurer of last resort? We've heard about Citizens down in Florida for wind, the FAIR plan in California for wildfires. What exactly is that, and what should people know?
Well, traditionally, and legally, the marketplace is, insurance is state regulated, and every state is charged to regulate the carriers that operate in their state. And those carriers that operate on what's deemed to be an admitted basis have to file their rates with the state. They have to file all their forms. They have to be approved. And so when you're in a state that has had difficult losses or has had a situation of the rates they filed can't cover the losses that are happening, they just pull out of a state, or they just pull out of classes, or they pull out of certain regions, and there's a default into what's called the excess and surplus lines world, which is the market of last resort. It's supposed to be. So that whenever you can't place the business with one of your direct markets that are filed as admitted and overseen by a state, it goes to this alternative world where the rates are not filed. The forms are not filed. It puts a heavier burden on your agency to see the forms and rates that are being charged. But there is a world that is not as regulated, therefore gives them the freedom to be able to charge what they believe. It's more of a true marketplace, and you have to make people compete in order to get the best the market can bear. And the state's not dictating what they're charging. So, but those companies, come in. A good example, and we've had several of these, Kevin, with your clients, where they had one policy on their property 2 years ago, and now they have 5. Because they needed, and the limits have shrunk. So now, instead of having a $50 million limit that is a competitive price at the time, now the market is bearing 5 carriers doing,
carrying limits, doing the quota share program, right?
% each in the 25 million limit. So, and the premiums doubled or tripled.
Yeah, I think hopefully, the term I think 2023, 2024 was really hard. We were using the term double, half, double the premium, half the limit, right? Double the premium, double the deductible, half the limit. But like you said, we're seeing some levelization with that. Meredith, I think that coming back to healthcare, one of the trends that we saw throughout the pandemic was an increased awareness in and around mental health. Any thoughts about, trying to find increased access? We talked about contract providers, a lack of them. It seems like people, are really struggling to find access to that. And I think, another comment too is from talking with individuals in our customer base, talking about care, the relationship you have with your doctor, and trying to go in and have a conversation. If there's not a symptom, if you're not sick, why do you need to come in? Well, I want to talk about my health. I want to be preventative. I can do my blood draws, my testing, but having that conversation relationship with your doctor. Any thoughts or comments in around particularly mental health and the access to that and how it's going to go?
Yeah, if you think about the mental health space in terms of providers and how they're their practice is set up. They're typically 1, maybe to 3-man practices, and
Mhm.
they're small and they operate pretty lean. And so the existing reimbursement methodology that happens with payers doesn't really work for their setup. So if you think about how a claim is processed, usually takes somewhere from 30 to 90 days to reimburse providers, or to fund the actual claim. And so many providers in the mental health space, that just doesn't work for them, right? And so they don't have contracts with providers. They charge patients directly, and then allow those patients to submit their bills and be reimbursed. I think this creates a huge strain in our healthcare system. Quite honestly, I think what we're finding is that mental health leads to various other conditions, chronic conditions, including obesity, diabetes, et cetera.
Yep.
So it's certainly something that is becoming more and more prevalent and obvious, and we've seen a lot of investors invest in digital platforms for mental health specialists. And I think you're going to continue to see more and more of that, where investors come in and purchase practices or hire mental health specialists, and it's gonna turn into more of a program that employers can purchase into to help support the need, as more and more payers are seeing the urgency around this, and the impact that mental health can have on other medical conditions and claims expense.
Sure. And then you talked about payers, increased competition among payers. You talked about, I think, that before, new entrants like MGUs and carriers in the stop loss marketplace. What are you seeing for trends in 2025 for rates? And what are you seeing, trends from people that are fully insured shifting to self-insured?
Yeah, that's a great question. So if you look at payers, and look at EBITDA, which is just a profitability measurement,
Yep.
it declined from 17 billion in 2019 to 13 billion in 2023 for the commercial segment. So significant decline. Again, we talked about those 3 major reasons that we haven't seen huge utilization. Contracts are stale. Payer competition has been heavy, and so we haven't been able to really capture rate increases in the past. That paired with the increase in technology, the increase in funding in what is called HST, or health services technology, and also what we're seeing in the pharmacy space. So you talked about growth in pharmacy. Total pharmacy dispensing revenue grew 13% year over year in 2023. And we're only going to see that continue to grow. And so we've got to figure out, as a payer segment, how to actually fund all of that, right? Because we're going to see certainly increases in claims cost and administrative expense. And in the fully insured space, that's all going to result in an increase in premium. The tough thing there is that as a fully insured employer, it's very hard to manage that increase in premium. You don't really have the ability to pull levers to reduce claims cost. The only lever you really have is plan design. And so more and more fully insured groups are transitioning into the self-insured space, whether that be through a level funding alternative, full self-insurance, or captives. Captives are a huge topic in our space, where employer groups are banding together to leverage the law of large numbers, and have more purchasing power when it comes to buying insurance.
Yeah, that's great, and we see that trend as well. And I think it's tough to influence behaviors, and you've got a system that may not be set up to influence the best behaviors. We were looking at it before, and you go on to your health provider's website and you look for the lowest cost provider. I don't necessarily know if it sends you to the MRI that's going to charge them $500 versus the one that's at the hospital is going to charge them $5,000. So, it all comes down to education and helping your plan participants make the best decisions for their healthcare. Jeff, what are you seeing as far as risk retention goes, self-insurance, hard markets? I know we'll talk a little bit about tort reform and what's driving the liability market. We talked about and self-insurance pushing up limits. That's kind of forced upon you by the carriers on the property side of things. But from a liability standpoint, you seeing more people taking on and self-insuring more risk?
Yeah, I'm not as familiar with the health and benefits space, and I
Right.
could have what Meredith just said about all of that is pretty much parallel exactly what's happening in the property casualty space. I guess I look at it and and think about the saying that cash is for business owners, cash is king and data is queen. And then further to that, the queen may say, yeah, the king may be the king in the head, but I'm the neck and I can turn the head any which way I want to turn it. Well, the data is what is driving people to take action. And so the data doesn't lie. It's more accessible. There's more confidence. I'll give you a couple of examples if you don't mind.
Right.
So I was in Germany about a year ago, meeting with the head of all of North America of one of the reinsurers that was on the list I just said, and we were talking about. He was very interested in the alternative MGU, alternative program space, and how they can support it, and that's why I was there. And I just talked to him. I was working on a cyber program, and he said, Jeff, we write over $1 billion in premium with cyber, and we don't have a clue what we're writing. And they stopped writing it for 6 months so that they could study their data. The reason was because they were reinsuring all the major carriers out in the marketplace that you'd recognize.
Yep.
And they were just trusting them for their underwriting. They were just reinsuring layers of risk. Well, the results were getting poor, and so they dug into the data and they made changes. That's happening more and more on the reinsurance side.
And it's an interesting example, Jeff. You bring up cyber. In 2021 and 2022, we were talking about how hard the cyber market was. To those exact points, they were seeing the losses and the claims. They put underwriting in place. The rates went up, and now we're seeing a softening in the cyber marketplace. So it really is line by line how the property and casualty marketplace responds to trends. So one of the big trends right now in the national insurance conferences, they're talking about tort reform. I was just down in Florida for spring break. I was on my iPad at night on YouTube and was targeted by an ad. And the ad talked about how tort reform, and it was brought to you by a political action committee, is costing each American family $4,200 a year in an additional tax. And that's a flat tax across all the board. That's increased homeowners premium, increased automobile premium. And then it costs more for your residential HVAC contractor to come to your house because they're paying more for their property, for their automobile insurance. And we say all these things between Meredith, between you. We don't cry for the insurance companies because what ends up happening is they raise your rates. So, we're on our client side where we're just trying to explain why some of these things happen. But at the end of the day, we want to keep these things low. And that's why tort reform is so important. So just wanted to go through real quick. Tell everybody on the webinar that Florida, it got so bad in Florida that last year they finally passed tort reform in Florida. It was House Bill 837. And so when we say tort reform, what does that mean? So one of the things that they did was reduce the statute of limitation. In Florida, you had 4 years to file a claim. They've reduced that to 2. Shifted from a comparative negligence. Previously in Florida, and again, all these laws are typically on a state-by-state basis that we mentioned before. But prior to tort reform, the claimant, the plaintiff, could be 90% at fault or more, 95% or more for it. But as long as the other party had at least some little part of negligence, suit could still be filed. They changed that to say that, hey, look, if you're 50% or more at fault, suits can no longer be filed. Changes to attorney fees and how those are collected and what was included. Different bad faith insurance reforms, medical damage evidence, premises liability and negligent security. Can you talk a little bit about what you're seeing for tort reform, why it's so important, and then maybe interesting too enough for everybody. Georgia is another state that is having a lot of issues. They're passing some level of reform there as well. But one bill that didn't pass was in regards to third-party litigation funders. Maybe talk a little bit about what those are, how those operate, and I think it'll be interesting for the people to learn.
Yeah, it's a pretty broad subject because it is by state.
Yep.
The plaintiff's bar is always looking for ways to make money, and they definitely encourage folks to basically they see opportunities in the current marketplace to make money in the states that have less, that have very liberal tort rules, et cetera. So they target it and they bring in investors to be able to fund the targeting of those because they know they can get class action suits and big awards. And then to get to that point is pretty sad.
Yeah. So one of the terms that they talk about in the industry now is nuclear verdicts. Those are awards over 100 million. The new term that's coined is thermonuclear verdicts. Verdicts over $1 billion. And talk a little bit about maybe the impact that's having on umbrella limits, capacity, and the ability to provide those.
Yeah. As you can imagine that if you're an insurance carrier and you write a policy, which is a contract that says you're providing this person, let's say up to 5 million in limits of the primary GL, let's say, in the next 5 million, and that you go you're in a state that basically the judge or the jury doesn't care that you have 5 million in limits and they are awarding 10 million because and that you only have maybe 2 to 5% negligence. That carrier sees that and says, I'm out. I'm not going to do business in this state.
So talk about the 2 to 5% negligence, right? Where we see, here in Pittsburgh, a lot of people here in Pittsburgh, ICE is on the overpasses the other day, multiple car pileups, minimum limits for automobile, $15,000. One vehicle number 5 in a 15-car pileup, but they're the commercial vehicle.
Yeah.
Even though there's no fault, the insurance companies are paying.
Right. I'll give you an example, and I got to be careful because those in Pittsburgh would know this story. I was close to it, but the laws in Pennsylvania around liquor liability, for example, most carriers have left the marketplace because in Pennsylvania, every carrier is afraid to fight a claim because even though you're in the business of serving alcohol and that's your business and you're supposed to only be responsible whenever you're negligent, which is has been defined, that visibly intoxicated you got to stop,
Right.
or provide them an alternative transportation, etc. But when you have claims on an area like that, and you have very little negligence, even videotape of the people, and the carrier looks at it and goes, I'm too afraid to fight this. I'm just going to pay $6 million. What do you do as a business owner? Like what are you have to go to your state rep and start screaming, and you got to start, not screaming, but you got to go to your state rep and say, look, this is a problem. I can't operate.
You're exactly
Yeah.
right, Jeff. And, as we kind of leave this topic, it is an awareness campaign and talking about how is an inflation, it is a tax on all businesses. And again, we're not crying for the insurance company, but they're heavily data driven. And they say, hey, 9 out of 10, we can fight it. But that one time we lose and we get that nuclear verdict, we've run the numbers and it doesn't make sense because of how the judges and the juries award the limits. And again, you talk about a situation where something bad happens or you're dealing with the vulnerable population, they're sympathetic and they're awarding these big limits. And then, like you said, with third-party litigation funding, where what the tort reform wanted to do was to allow the defense to say, this person that's sitting here as the plaintiff has already settled the case. They've received their $500,000. If you award this case the $25 million they're asking for, it is not going to this individual. It is going to a foreign company that has funded and bought this case. And we want to tell the judge and the jury that because we think it's important. And they said no. So we don't have all the answers, but like you said, talking to your state representative or whoever that is, political opponents, would think. Meredith, coming over to you, talking about the American healthcare system. We don't have all the answers. We've got a lot of great things as part of it, maybe some things that could be changed or could be tweaked. What are your thoughts about the future of American healthcare, fraud and abuse, or any things that you think should change sooner rather than later?
Yeah, if we could have changed this years ago, I think we all would have. But the one thing that I think is going to have significant impact and we're going to see quite a bit of in the next 3 to 5 years is steerage. So side of care steerage. It is the next big thing. And I think it'll be extremely effective in terms of claims expense. I'll give you an example.
Right.
Infusions that are performed in the hospital setting, the infusion itself is usually marked up somewhere between 200 and 300%. If through site of care steerage programs, you can steer members to ambulatory care centers, or they can have a nurse come to their home and create significant savings. In fact, we just saw a chemo drug recently that was being billed at around $39,000 for a 3-week treatment. So $39,000 every 3 weeks.
Mm-hmm.
We found a pharmacy that could secure the drug for $9,000 every 3 weeks. So you're talking close to a $500,000 annual savings. So I think we're going to see more.
500,000, you said, right? Not 5,000. $500,000 annual savings for the one.
For one drug.
Yes.
And think about the number of infusions that you have on a health plan in a given year.
Yep.
So it's egregious in a lot of cases. And I think the age-old term, I don't want to lose my provider. The fact is, if you're getting an infusion in the hospital setting, your provider is not administering it, right? And so it's an easy way. There are easy ways to cut claims expense that we really haven't taken advantage of in the past, and are certainly coming to light now. I get a lot of questions about what's happening in the government and how that's going to impact our industry. The answer is we have no idea right now. It's sort of all over the board. But what we do know is that there is a huge increase in government, in the government sector, so Medicare, Medicaid, and we do expect that space to continue to grow as well.
Sure. And with that comes its own set of problems where I think you've got aging services, which is heading for tragedy, where there's so much, the reimbursement isn't keeping up with the expense. And as more people shift to Medicare, maybe break even, Medicaid lose money, and you don't have private payers to make that up, and we've got the baby boomer generation coming up to utilize those services. I'm terrified, quite honestly, of what's going to happen, in those types of scenarios. And
yeah, in the gene therapy space, on average, a hospital system, 15 commercial patients to make up for one Medicaid patient.
Right.
I mean, the reimbursement model is drastically different, and providers inevitably make up for it in the commercial space for sure.
Yeah, and I think some of it is, like you said, years ago, the healthcare system was zero deductible plans. I paid my premiums. I went to the doctor. I didn't necessarily grow up feeling the need to be a good consumer of health insurance, and increasing those transparency tools and educating people, our members, our employees about that. We had a scenario just the other day. Everyone's getting older. They needed a knee replacement. Same doctor. If they did it in the hospital setting, the cost was $11,000. They do it in the outpatient setting, the cost is $3,000. And you ask the doctor and you say, do you get less money? He says, no, I get the same amount. The hospital's making the margin on that.
Yeah.
So there's like we talked about with prescription drugs, there's a lot of margin. We've seen it and have mentioned to clients about cost plus drugs and other ones that are direct to consumer. Obviously, those don't hit your deductible, but the difference in the delta in the cost of those drugs is, like you said, the $500,000 staggering amount.
Yeah, that's right.
Any other thoughts or comments or questions from those folks in the audience? We've got the experts here. We've got 3 minutes left in the presentation. So if there's any outstanding questions, we're happy to ask them. If not, Meredith, Jeff, anything else that you guys have had prepared, do you think you'd like to share with the audience?
Yeah, I'd love to just say that, you listen to a conversation like this, and I know being a business owner for years and years, it feels like, well, then what do I do? And, I like to talk about, well, control what you can control. And so concentrate on being best in class, concentrate on doing the things that you can control relative to your own risk. And also, try to go down a path of tort reform if you're in a state that needs it. Everyone does, really. It's a societal issue, I believe. But I think of this, if a lot of you remember growing up where, if you had good grades in school, you get a free McDonald's hamburger, right? If you have good grades now, 10, 20 years ago, 15 years ago, your auto insurance actually is affected because kids with good grades on your auto
Sure.
have proven data-wise that you have less claims. Well, that's what's happening in this next phase of the marketplace. So now that they're armed with data or can obtain it, now that the market's plateaued, they're going to be really careful about where they're soft, where they give back. And they're going to give back in those areas of folks that are adhering to their monthly, driver training, are adhering to, all
putting
of those
in telematics,
things.
putting in outward facing, and you're exactly right. The old standard is becoming there's becoming a new standard where having inward facing and outward facing dash cameras was a nice to have. Now it's almost a have to have.
Yeah,
and
on a larger fleet. Yeah.
And it's even something that people should start to consider individually. We've seen the videos on YouTube of people backing up and causing these accidents, and then, oh, my neck, oh, my back. It's a shame, but there are professionals out there. And again, when the deck's stacked against you, the more evidence you have. Otherwise, it could be challenging. So that's great. Appreciate that, Jeff. Meredith, thanks so much for coming. That was a really awesome presentation, some great insight. Thanks to you as well, Jeff. And thanks for everybody in the office or in the audience for attending as well. I hope everyone enjoys their Masters Thursday and stay well.
Thank you.
Thank you.